Welcome to another episode of the Strive for 25 podcast. And I'm looking forward to today's guest, the cash flow guy. You can find him on Twitter. And he is a real estate investor, has a W-2 job as well, and kind of really fits what we talk about a lot here on the channel. And it's the, hey, how does the everyday person build wealth and march towards financial freedom? So, cash flow guy, thank you so much for joining us today, and give us a little bit of background on who you are and what you do.
Sure. Well, thanks so much, Joel, for having me on. Just wanted to say that first. It's a really interesting topic, getting enough money to be able to invest in real estate. I know a lot of what I hear on Twitter is, first step, daddy's money, right? Have an inheritance. And that's one way to do it. But I do think, there's a lot of ways for your everyday person to get there. So we can dive into, what's worked for me. I'm definitely not where I want to be yet, but I'm definitely making good strides as well. So hopefully, whoever's listening to this can find some useful tidbits and tidbits that could be applied to their situation. So yeah, a little bit about myself. I'm a CPA. So during the day, I'm in technical accounting. I do that for a fintech startup. So people call us the lawyers of accounting. Basically, why are we accounting for this transaction the way we are? Right, using guidance to document that. So I'm a pretty analytical person, both legally, able to read contracts, but then also, with the quantitative side of things. So I do that. I'm obviously growing the cash flow guy on Twitter, been creating, sharing content there for coming up on a year now. And that's been amazing, met a lot of cool folks and just been learning a lot on that platform. I sell plastic spice jars on Amazon. I'm probably the least passionate about that of any side hustles. It's, I think it's great experience and I'm getting close to profitability, which will be a nice milestone for me. But I think that was just something, I wanted to do before I really had enough money to do real estate, but real estate really gets me going much more. And then, yeah, so my primary side hustle for now, I hope, it'll be my full-time hustle one day, is real estate. So we own one rental. We have the body of a second rental. We can get into that later. Just need to do a little bit of renovation. And yeah, I got a lot of projects on the docket and starting to get to a point where we'll have kind of a capital snowball to be able to do more. And we can talk about that more in a little bit as well. But yeah, that's me in a nutshell.
So for our listeners out there, we have an individual here who's got a full-time job, CPA, a couple other things he's into, real estate, and you're in your mid-20s, right? 27, I think you said.
27.
So how old were you when you got into the game? What age were you at on the first property?
So the first property, we started building it when I was 24. And we moved in because we built our first property and then we moved in and it was kind of ready to go when I was 25. That's when we closed on it.
Okay. From a down payment perspective, just for people out there, did you do 5% down? What type of loan did you do? And what type of down payment did you have ready to go on that first property?
Yeah. So we did a 15-year conventional. So that was, we moved from the Bay Area, right? I was living in Oakland, which is pretty high cost of living, to Colorado Springs. So it was definitely, the landscape there for real estate was more affordable for us. So we were able to do 20% and for the down payment, and we did a 15-year conventional loan. The payment wasn't astronomically more. And for us, we really believe in the Colorado Springs market because, when remote work hit, all these people were moving from places like the Bay Area and New York and Chicago, right, to places like Austin and Denver and Colorado Springs. So what happened was all the prices in Denver went up, right? That priced out a lot of the locals there. And a lot of the locals were moving down to Colorado Springs. So you're seeing this explosive growth in Colorado Springs. So the 15-year play there is, even though I am the cash flow guy, I do like equity plays as well. So that's an equity play, right? Throw a few hundred more. I think it was like 900 a month. Um, and then I'm 40, my girlfriend will be 39. We'll have 100% ownership of that property.
Right. So we're going to kind of dig into the full kind of scope of the journey. And because right now you're currently in San Diego, California,
Yes.
you own a house
Mhm.
there. And the rental part, project part, you got a property that has an ADU. So we'll dig into all that stuff in a second. But um, right now, the reason why I wanted to kind of point out the age is that the average age of a first-time home buyer right now, based on the data that came out from National Association of Realtors earlier this year, the first-time homebuyer age average is 35 or 36. And so
Mhm.
to me, it's like, hey, I just turned 40 this year, and I know from a real estate standpoint, like I've had this whole crazy winding journey that's got me to where I'm at, but I got in the game in my late 20s. And so having that time to be able to have things work for you and figure things out and whatever, and you're getting in the game at obviously a much, lower age than the 30 to 36 average. So going into it, why was it important for you to do it? And from a cash flow perspective, you know, why do a 15 year, and how did you kind of analyze the data? And why did you do that?
Sure. So I think the why for me was largely when I got into my first job, it was in public accounting, a CPA firm. And I think you and I have discussed this in the past as well.
Yep.
I got in and I was very ambitious in the beginning, right? I was like, okay, I'm going to stay at this firm for my whole career. Coming out of college, they pump you up with all these ideas. I'm going to stay at this firm for my whole career and I'm going to get promoted over and over and be a partner and make all this money and have like a high stature in the CPA, ecosystem. So those are my set of goals coming out of college. So I got there and I looked up and I saw partners working a ton, right? What didn't feel like they had made it. Like I know they're getting massive paychecks and they have equity in the partnership. Um, but I was hearing stories like they were missing their kids' birthdays and they, were sleeping 4 hours and they don't work out anymore. And it became pretty clear to me really fast that was not the end game I wanted for my life. And I'm sure this story is somewhat cliche, right? A lot of people have gone through the same thought process. So pretty quickly, I realized, there's got to be a better way, right? I do want wealth. That's important to me, but I'm not going to do it through selling myself for like 80 hours a week forever. Just didn't seem to make sense. So it was hard for me to do too much of that job because it was so demanding. Um, so we had started to build the house while I was at that job, but then I quickly changed jobs to one that offered a lot more flexibility, less hours. And that's when I was really able to start pouring time into researching real estate, going on bigger pockets, getting on Twitter, really setting up my sources of information. Um, and I was calling people when I could, calling lenders, calling investors, whatever I could get my hands on, right? And it's interesting because you accumulate knowledge, right? And then all these people are telling you, okay, you just have to take the leap, right? You have to actually get your hands dirty. So I was like getting increasingly impatient to gain real life experience, but obviously real estate costs money. So I was saving. And the thing is, when you build, right, you can start building and not have the money yet. And I'm going to repeat that. You can start building and not have the money yet. I don't know if that's obvious to everyone, but to us, that was huge, right? Because you benefit from the appreciation during the build process. In our case, I was 14 months. Our home appreciated 29%, and we had not made our down payment. You have to put down earnest money, this 3.5% out of 20%, right? So it's kind of a drop in the bucket, and you get to ride the ride without paying admission. So I just
Mhm.
thought that was crazy. So we didn't have the full down payment yet. We had most of it, and we made a plan where we knew we could save it by the end of the 14 months. Um, so that was a big way for me to feel like I was getting in the game, right? And starting to get experience before I was fully ready to, make a real down payment. Um, and then, so to your question about the 15% versus the 30%, I have a good amount of experience, building forecasts, building financial models. So I guess the mechanics came somewhat naturally. But at the core, it wasn't too complicated. I basically created amortization schedules, and there's tools on the internet for this, right? You put in the value of the home, the amount of years, your estimated interest rate, and it'll spit out a full table of your payments for the 15 years or 30 years. And I looked, and the payments were about $900, $2,000 different. I spoke with the lenders about it. And then, I didn't get too fancy at that point. I was earlier in my career with, IRR and all these, fancier financial metrics. But I looked at it and just said, both of these are in a very safe uh, kind of bracket of payments for our income, right? Neither of them are going to be over a third of our income or over a half or make us unable to save or invest more. They're both kind of in the safe zone. Obviously, the 30-year was easier for us, but the 15-year was very doable for us. Um, and then, if nothing else, no other investments, right? By the time we're 40, I looked at the rent at the time. It was like, I think 3,300 is what I would estimate for that house, and multiplied it by 3% every year for 15 years. And I forget what the exact number was, but it came out to, I don't know, much more than 3,200. I want to say 5,500, something like that. So let's say 5,500, right? So then if it's 5,500 a month, you don't have a payment, you're paying some insurance, some taxes. Let's say that brings it down to $5,000 times 12 months. That's 60 grand, right? That's a salary. It's not a full salary that could cover all of our expenses, but that's a salary, and it's a very meaningful, contribution to financial independence. So we felt like we could just do that at a minimum, lock it in. We're in a good spot, and then obviously, add a few other things to that. So that's our uh, foundational investment kind of for the rest of our journey.
Got it. Yeah, there's a lot to really kind of dig into that. Me coming from the lending background, I have some questions for you. Um,
Yeah.
from a standpoint of the rents and your 15-year payment. So closing the property, the rent's there, you say maybe 32 to 3,300. So is your payment higher or lower than that rent level projection, just in theory?
So our payment when we started was 32 and change. I think it's taken a little hike since then because of taxes. So now it's 33 and change. Um,
Gotcha.
and when we actually rented it, which is, a couple years later than the time period we were talking about, we're getting 3,600 now.
Gotcha. So yeah. So at that point in time, you mentioned the $1,000 or so, maybe give or take difference between the 30-year payment and then the 15-year payment. So you take on the higher forced payment. And then do you remember what the interest rate difference was between a 30 and a 15? You don't, if you want to say
Yeah.
the interest rate, that's cool. You don't have to.
No, it was a little bit lower. Don't quote me on this, but if memory serves, I think it brought us down from 3.625, and this was March of 2022, to 3.125. Oh, excuse me. This is not March of 2022 because we did a rate lock. Um, I think we locked in June of 21.
Gotcha.
So we
Cool.
would have locked earlier, but then they had construction delays and you needed like a certain amount of progress before you could lock. So that
Yeah.
was actually brutal. We would have been in the twos, but then it was too cold. They couldn't pour foundation and it was frustrating. But yeah, so half a percent difference, which is meaningful for sure.
Yeah. No, that makes sense. I mean, I think from my perspective, typically it's like a 1/4% difference on as a rule of thumb between 30 and 15, but then obviously markets are always in flux and can change. And so that makes
Yeah.
sense. So at that point in time, rates are in, pretty much all historical lows. One of the things I always say is that 3.25 on a 30-year fix is kind of like that historical low that rates hit there in 2012 and 2013 and even in 2016. And so for rates to go below that level, which we did see rates in the twos, that all happened because of COVID and the chaos and all the things that are happening in the markets. But okay, so at that point in time, I wanted to hit on that because I also want to kind of address that also with the current environment right now in terms of people deciding to continue to get in the game to the next one, or getting in the game as their first property. So, um, great. So I call this the stair step methodometer. That's a 10 out of 10 on the stair step methodometer rating, because if your payments 2,200 on a 30-year fix and your projected rents are in the 3,000 range, that's a great place to be in terms of buying a house with the intent that down the road it could be a rental. So on the build process, you mentioned having that time frame and then switching jobs and working remotely. So the job that you were working at that had more of the craziness in terms of the hours and the commitment, was that were you working at that job when you decided to build in Colorado Springs, or switch? Did you already
Yes.
switch?
No, not yet.
Okay,
So we did, I guess, about 7 months of the build process while I was at that job.
cool. All the while you knew that maybe there's maybe a different opportunity out there.
Yeah. Yeah, I knew it was kind of a matter of time. Just needed the right opportunity to come along.
Cool. And then so you get to Colorado Springs. How long are you there? In that house? How long did you live there?
So we moved there in March of 22, and we were there through June of 2023.
Okay.
So 15 months. And I think something to highlight there, you get the best terms from a financing perspective if it's your primary residence, right? Rates are lower. You're also able to make smaller down payments. Um, and I think a lot of people only like utilize that fact once because they feel like buying a home puts roots down and there's inertia and you don't want to move. And trust me, I understand it. I hate moving as much as anyone else. Um, but I think a really beneficial strategy to maximize your capital early on is to move a few times and get the primary residence terms multiple times over. And then you have your primary residence conventional loan, right, against rental rates. And that's where you can actually cash flow from rentals. So, when we were moving to Colorado Springs, a lot of people were saying to me, oh, you don't know anyone there. And that's a random place, right? We were moving from California and, all these things are going to be committed, right? And we kind of knew the whole time, like, we didn't know exactly how long it would be, but we didn't feel like we were putting down roots, right? We felt like, we'll do a stint here. If we like it more, we'll last longer. We'll see, how much we're able to save, if we get raises, whatever. Ultimately, we do want to buy something else. We don't know if it'll be in the same place. But I think looking at it with, a flexibility or a willingness to adapt, I guess, is really helpful to, be able to get those friendlier terms on future properties.
Yeah, and I kind of want to come back to that in a second. But I kind of let's complete the kind of transition to San Diego. So what was going on
Sure.
with that move, and why, and how that all fit together?
Moved to San Diego.
Hmm.
Yeah, so I think ultimately we determined Colorado Springs was not for us. Um, just culturally, it was a little different. We didn't have any family or friends out there. Um, the reason we actually determined this was because I was gonna buy a dry cleaner, right? I'm always looking into different deals and getting excited about things. So I was gonna buy a dry cleaner, and I had built a forecast for that. And the real profitability, right, where it started to look really appealing was in years 4 and 5. So I sat down with my girlfriend and said, are we going to be here for 5 years? Does that seem realistic? And that's when we really thought about it and thought about, this is going to be the rest of our 20s, right? Does it make sense? Um, and that's when we kind of realized, like, okay, we do want to get to San Diego kind of soon. So, me being me, I started just compulsively researching San Diego, right? Looking into real estate trends. I started calling people, reading about it. Um, and, people have been predicting a doomsday in the economy for what feels like a long time now, right?
Yeah.
It's happened a little here and there, not like this big drop that, everyone's been expecting. But in early 2023, prices did come down a little. That was kind of the closest to that drop I think we've seen in terms of a housing price perspective. So San Diego is one of the pandemic, darling markets, if you will. Not like Austin and Phoenix and Boise and these markets that absolutely skyrocketed, but it did pretty well. So I think there's a bit of a correction there. So we saw prices coming down in early 2023. And, I'm not one to try to time the market, but that said, I can't completely ignore,
Yeah.
patterns as well. It's something that's somewhere in the middle. So we saw that. We saw there's pretty limited inventory, and then prices started to come back up as well. Um, and I don't care that much about rates, right? We got into a high rate situation here, but I think that if you can make the payment with the high rate, it's a matter of time, right? It might be 2 years, it might be five till we can refinance. And we've got these other projects that, I know you and I will get to in a little bit. And I think those will help out with the payments as well. So
Yeah.
we weren't too worried about the rates. So yeah, it was kind of those two things, right? But from a lifestyle perspective, we wanted to come here. We have family and friends here. We were kind of ready to move out of Colorado Springs. And we felt like the market was in a good enough place where it could make sense. And I guess the last note I'll have there is like, I really believe in being a contrarian when it comes to investing. There's always, always this notion of like, well, why are you buying when the market's about to crash, right? No one's buying right now. The volume of sales transactions is lower than it's been, and to me, staying with the grain means that even if you win, you can't win that like profoundly, right? Because if everyone's doing it, there's just not that much of the pie left for you. So I always believe not just, blindly doing the opposite of what everyone else is doing, but in an educated and informed manner, trying to find opportunities that do go against the grain a bit. And so this kind of hit that criterion for me as well, where I know a lot of people who are waiting and not buying largely because of interest rates. Um, so that was appealing to me too.
Yeah. And that's something that personally, I hear that same thing a lot. Like, hey, I'm going to wait till rates go down. And, I have my own thoughts and opinions on what that means if rates go down by a percent at whatever point in time. Um, but with that journey that we were talking about and, you know, buying something as a primary residence a couple different times, maybe you relocate, maybe you don't, but buying the next one as a primary residence and having the ability to put some lower down payments down if you need to. We call that the stair step method, being able to kind of scale in. And, you mentioned, flexibility to pick up your world and move to find an opportunity. And then you just talked about being contrarian, right? I mean, the people that are in your circles, whether it be coworkers or from afar or friends or family, how do you think most people are looking at that kind of, if you're in your 20s or 30s and picking your life up to find an opportunity for real estate or whatever it may be, what's the typical type of response on that?
Well, I think a lot of the people that I speak with, one of the reasons they don't want to buy real estate is because they're not ready to commit to a place yet, right? They feel like, oh, maybe I want to go and live in New York for a couple of years, right? I'm single, I can do whatever. Maybe I'll live in Europe, right? And they have like these ideas of, what if, and buying a house to them stifles that. Um, and it kind of limits their ability to try new things and go in new places. And it's a little true to a degree, right? Because you can't just sell whenever. It depends on the market and taxes and all this kind of stuff. But to me, you can rent for the most part whenever. Um, there's a little risk there, right? You could go to rent and rents have come down in your area such that now it's a negative cash flow situation. Um, but for the most part, you can move and rent, and you can access the equity through all these different ways, right? Cash out refinance, HELOC, all these kinds of things. So yeah, I think that's the general viewpoint I hear is like, you got to be ready to settle if you're going to buy a house. And I just fundamentally reject that. I don't think that's true.
Yeah, I'm on the same page for sure with the way I look at things. Um, Staying kind of going back to the very beginning of the process, you mentioned research and talking to different specialists and kind of the industry and whatnot. What are some of the things that you've learned throughout the process that you think are important for someone to be aware of in terms of home buying, lending, terminology? You mentioned buying as a primary residence as one example, but what other things come to mind that you think would be important for someone to be aware of?
So I'll say a lot of it's like specific to my situation, but I guess that's the experience from which I'm speaking. So a lot of it's related to San Diego specifically. The ADU laws here, I think, are pretty unique. Um, and what's in code, what people are doing with construction, contractors. Um, there's different rules. Like you're depending on the zoning, you're not allowed to have living space cover more than 59% of the lot, right? So we were looking at bigger lots and always saying, okay, well, we want to do for this property, it needs, a new primary suite, it needs a detached ADU, right? This is kind of our road to cash flow, our road to refinancing and having a friendly payment. And then, okay, if it's this big and the house is this many square footage, and I kind of like internalize the 59% rule, right? So then when I see a deal on Zillow, I immediately see, okay, the lot's 6,200, the house is, 2,000. I do this and this, and oh yeah, we could totally make this work. And just getting in the reps, I think is helpful there. Um, and then with lending, is the different types of lending really, because we were looking at, so for this property in San Diego, we were not looking at a 20% down payment, right? We were looking at either doing an FHA loan, where the down payment would be 5%, or a conventional where the down payment would be 3.5. And there's different maximums there. I think that it's changed by locale. But I think it was around 1.05 million for conventional. Maybe that was FHA. I'm forgetting the numbers right now. It's been a few months, as you can tell.
Yep.
But at the time, I had internalized that. And what does that mean? Okay, FHA, you have to live here for a year, right? And there's a couple requirements there as well. So I think it was just understanding that. Oh, and then okay, see now my memory is getting jogged. Another big piece of it was offers, how to make offers. We were fortunate to find a terrific real estate agent. I found him on Bigger Pockets. He had all these reviews. If you ever listen to the Bigger Pockets podcast, David Green talks about finding an agent who's also an investor, right? Because they're going to understand your perspective. And at the same time, you know, showing them that you can be a true partner, not a one and done first time home buyer. So I shared with him my visions of, building a real estate portfolio in San Diego and finding someone to do multiple transactions with. And I think that, resonated with him. So, we had a great relationship. So he had kind of a team, a lender, title company, inspector, all the right people where we could make offers with a 9-day close. And that was a pretty big differentiator because right now, how the market is supply is super low, right? So even though there's not a ton of demand, the supply is so low that the demand is still amplified for each property, and there's still a lot of competition. Um, so when you go to make these offers, first of all, there's a lot of flippers that waive all contingencies, right? And they don't care if there's a foundation issue, whatever. They're expecting to blow 6 figures in construction. So that's hard to compete with because we're not there, right? We can't deal with a massive, infrastructure issue under the hood. So what we were able to do is offer this 9-day close, which was faster than anyone else making offers. Um, we included the loan contingency, or excuse me, we waived the loan contingency. And then initially we included the appraisal contingency, but ultimately ended up waiving that too. Um, and we waived the appraisal contingency. Uh, Even if there was a huge appraisal gap, I think we would have just called out something in the inspection and kind of used that to back out from the transaction. Um, but yeah, we tried to target um, properties where we didn't think there would be too big of a gap between the purchase price and the appraised value, because then you're on the hook for that gap, and it's cash that doesn't go to equity, kind of just disappears in value. Um, and then luckily for this home, it actually appraised dollar for dollar the exact purchase price, um, which I think is a little shady, but obviously it's good for us, because we didn't have to pay any additional cash out of pocket. So that was a win.
What was the offer price above or below or at the listing price, the list price?
It was at the second listing pricing. So the sellers listed, I think it was like 865, something like that. Um, so our initial offer was 900 because there's a lot of competition, right? And then they selected us and a few others to do a best and final offer. And they shared, some numbers were above us, no contingencies. So then we offered 925. They selected someone else's offer, not us. So we missed out on this. So then we were making offers on other properties. And then they came back to us and said, hey, that deal fell through. We're starting completely over, doing a whole new open house. And we were like, do you just want us to bump up our numbers a little? Because we felt like there's a ton of potential. We could do all these projects. 10, 20 grand is not going to, it's not really going to make an impact long term, especially, with the leverage, we're making a 5% down payment. It's not that much cash out of our pocket. So So ultimately, oh, and I'm gonna reverse a statement earlier. I think FHA was 3.5, conventional is 5. Now that I'm thinking about it.
I wasn't gonna call it out, so it's all good.
Okay, okay, yeah. Because yeah, we're at 5. So anyway, so what happened is then we went to the new open house virtually from Colorado, and then we made an offer for 935, which was the new asking the second time around. Um, and then it was so weird. The seller said, all right, we're going to collect offers through Wednesday night. This was on Sunday. We made the offer through Wednesday night. We're going to evaluate and pick the best offer. And then Monday, like afternoon, she calls our agent and just says, like, you guys have been here the whole time. You've been following up with us. You seem transparent and like you're going to really close. And we need this to close after it's fallen through once. So we're just going to select your offer and not even wait for these other offers to come in. Um, and that was a really cool moment because, I got to give the credit to our agent. He had been just following up and putting in FaceTime whenever he could. And yeah, so I don't know if another offer would have come in that was higher than ours. Probably, it's a nice property. Everything's super competitive, but yeah, we got it right at asking just because of kind of how that situation developed.
Yeah, and there's a lot of good agents and good lenders, and there's a lot of people that aren't as polished or experienced to know what buttons to press or what conversations to have at what times, and having a
Mhm.
good team, that's been together, knows how each other work. Because as a lender, it's like, okay, having a relationship with your realtor, know how they do things, and then where I need to kind of jump in and have a conversation with the listing agent to help, maybe um, create that strength of that sense of strength of the offer to the listing agent to help your buyer. Like all those little bit of things matter. So having a good team is important for sure. Um, the the ADU, so building that additional unit onto the property and looking at the different square footages and the percentages. So this property did not have one, and your plan was to build it from scratch. Is that right?
So yes and no. So this property has a converted garage. That's a one bed, one bath unit, but it was marketed as being up to code and done by licensed contractors. So we were planning to rent it pretty soon after getting here. Um, we've actually found that there's some issues with the construction. So we're getting quotes right now. We might be able to kind of go back to the seller and say, hey, you claimed this, you didn't disclose the true nature. And the seller was her own real estate agent. That's her full-time occupation. So she has some kind of reputation to protect there. So she seems willing to, collaborate with us, and she's claiming she didn't know. But anyway, that's besides the point. So once we get that ADU up and running, that's ADU one. It's technically a junior ADU because it's attached and it's smaller. Um, and then the backyard, we're going to create a detached ADU. The backyard has a hill towards the back, right? So there's maybe for like the back 14 feet or something, there's this incline of dirt with some plants on it. So we're going to remove all that and put in a retaining wall, and it's going to really open up the yard. And that's what's going to allow us to put a detached ADU in the backyard there. And that ADU can be up to 1,200 square feet as long as it meets the different offset requirements from the back, the side, and the main house itself. I think I've heard that the permitting is much more timely, or it takes longer and is much more costly if it's 750 square feet or higher. So a lot of people offer these designs for 740 square feet, and you can squeeze 2 or 3 bedrooms. They're not huge bedrooms, but you can get that into a 740 square foot unit. So I think that's probably what we're going to end up doing there.
That makes sense. And from a rental standpoint, once that's completed, what do you project the rents to come in for that one? And then that also means you get to keep the garage space too.
Mhm. Yeah, so the garage space, we're thinking about doing a short-term rental. So obviously it's a little harder to project that. But if we were to do a long-term rental, I think we could get about 2,000 a month from the one bed, one bath. San Diego rents are super expensive. I actually just saw an article that they surpassed San Francisco rents for the first
Whoa,
time in a while. So they're like, it's the third highest rental market in the country.
that's
They've
crazy.
outpaced inflation and all this stuff. So that's kind of wild. Um, so yeah, so I think 2,000 for the one bed, one bath. And then for the detached ADU, if it's a two bed, I think we could expect around 3,000. If it's a three bed, probably like 3,600, something like that.
So that'll obviously, make a major dent into your just normal mortgage payment, which then allows you to save more money. And then if for whatever reason life changes and you exit the property and go on to the next one and you're renting out all 3 units, then you're going to be exceeding your expenses.
Correct. Yeah. If we get to a place where we're able to rent all three and we move out, it would be pretty significantly cash flow positive. Um, it's hard to say because the ADU doesn't exist yet, so I don't know exactly where it's going to be. And
Yeah.
we're doing an addition to the main house, and I don't know what that's exactly going to look like yet. But I think the main house will be a 3 bed, 2 bath after the addition. Um, and we'll have a new, landscaping and everything. So I think the main house can probably rent for around 4,000 today. So if you have the 4,000, 2,000, and we'll say 3,000, right, for the 2 bed, 2 bath, that's 9,000 total. And yeah, our mortgage payment is kind of between 7 and 8,000 right now. So it would be not a full salary, but it'd be a nice chunk of change for sure.
That's awesome. And kind of cost per square footage, what kind of numbers are you projecting for the addition or total dollar amount for the addition? What does that look like?
So we're still getting quotes right now. It's my first time, dealing with contractors and going through the quote process with them. They're a little it's different than dealing with accountants. Um,
Yeah.
so I think I'm figuring out, how to communicate with them. Um, but I'm hearing anything from 250 to about 375 per square foot. Um, and there's different types of financing there. I'm learning about that right now. Um, there's a 203K program, which is also an FHA program. Um, and then there's also, I think it's called a home style, like Fannie Mae home style. I'm
Hmm.
forgetting the name. And that allows you to take the cost of construction and add it into your mortgage.
Hmm.
Um, and then there's like some shorter term financing and all this kind of stuff. So it's and a lot of the contractors, especially the ones with bigger companies, come with kind of financing brochures. So they have their own options as well. Um, some of them have actually told me to contact my lender for the house, saying that lenders for the house want you to kind of succeed with the property and want to stick with you. So if you have an existing loan with them, there could be a bundling opportunity to see, what they have available as well. Um, I haven't done that yet, but I fully intend to.
That's awesome. I mean, none of this would have been possible if you just went out and got a regular single family house and bought it, right? All this stuff is by just pure research and not stopping until you find the answer. Sounds like.
Yeah, no, I think that's an accurate statement.
I want to kind of go in a little bit of a different direction. You
Yeah.
know, we were talking about real estate. We're both on the same page. It's a pathway for the everyday person to be able to build wealth and to march towards financial freedom, and getting your time back, and not having to rely on a job, clocking in and clocking out, so to speak. So the social media side of things and Twitter, where can people find you on Twitter? What's your handle?
My handle is the cash flow guy. I think it's more specifically the space cash space flow underscore guy. And
What what's your thought process, or what's your goal with that platform?
my goal right now is really to just connect with people. I mean, I met you on Twitter, right? I've met several people who well, let me take a step back. I believe really heavily in your sphere of influence, right? Things like who you spend, the five people you spend the most time with, you're an average of them, right? I've heard that. I don't know if that's completely true. But also, you're kind of a composite of like your choices and your experiences and what you learn. So if you're just exposing yourself to misinformation or negative vibes or people who are complacent and not growing, right? I do tend to think you kind of flow in those directions, right? There's a current pulling you there. Um, so when it comes to real estate investing and growing and financial independence, my immediate circle is not really doing it. I think they might in the future, but at our current age, they don't feel the urgency, I think, which is okay. I'm not here to bash on anyone. And I love my friends and family, but I wasn't getting that element of the sphere of influence um, that I thought I needed to really push myself and keep learning and honestly just for inspiration to see what's possible. Right on Twitter, you see people doing absolutely incredible things. Right, they have 100 doors, 500 doors. They're starting this company and buying this company, and it's just crazy. And I think some of them are probably embellishing. Right, I don't think it's 100% true. Um, but still, it's just a great thing to have in your sphere of influence. So that's my main reason. Also, in terms of my content, right, I'm not claiming to be an expert. There's always someone commenting like, "Oh, you just bought your second house. Like, how are you a finance guru?" Right? I'm not a finance guru. I'm an average 27-year-old guy. I went into accounting, and I'm just on this journey. And I think that it's a helpful perspective for people to see someone who's transparent and sharing, their screw ups as well as their successes and lessons learned along the way. And I hope that some people can relate to my content and hopefully it can inspire someone else to take their leap. Um, because we talked about earlier the capital required to get started, the stair step method, right? What the stair step method really means is like you need, and I don't want to put words in your mouth, I know you coined the term, but to me what it means is you own property and use the equity of that ownership to kind of springboard yourself to be able to own more. um, but when you think about that, it's contradictory, right? I'm just trying to buy real estate and you're telling me to own real estate to buy real estate. Like that doesn't really make sense. um, but I think that if you get inspired enough, which is kind of, a big part of the role Twitter's playing for me, then you start to research, how is it possible, right? How can I do this? And you see things like you can build when you don't have the money, right? You can put down 3.5% if you find the right program. There's like tricks and ways to do it. And then all of a sudden, instead of needing, the 150 grand that you thought you needed, so you figured you wouldn't even look into it for 10 years, you actually need 17, right? And you can get 17 just by saving a little more this year and maybe taking a small loan against your 401k. All of a sudden, you're in the market for buying houses like today, right?
Mm-hmm.
So that mindset shift is really an unlock, and Twitter was part of that shift for me.
Is there something that you know now, being in the game for a few years now, that you had no idea to even ask the question or even to think that thought?
The answer is yes. There are many things like that.
What stands out? What's something that you think is important to be aware of? Someone's just starting out.
To someone who's just starting out, I mean, I would say this may be obvious. It is obvious. Well, it's obvious for me. Um, but I think like having just a healthy degree of skepticism is important. And I feel like that's kind of going against my overall messaging today, right? Like I fully believe you should be optimistic in the way where, I can do this, right? I can save the money. I can move 1,000 miles. I can build a house, whatever, and just like make sure you get it done and deliver on those things. Um, but at the same time, when you're analyzing the deals and you're, I don't know if you're in Excel or how you're analyzing them. For me, it's Excel. Um, you want a healthy degree of skepticism, right? Like, let's assume you're trying to rent it, it's vacant for 2 months, right? Don't model in that you're able to refinance at a rate that's 2% lower after a year, because that might not happen, right? That'd be great if it does. Contractors, construction costs, add like 20 or 30%, add 6 months. People, things happen. I think that's been a huge takeaway for me is there's all this unpredictable stuff. We're in a dispute with our seller. The contractor we thought was going to do our project just completely dropped us, doesn't want to deal with the scope of the project, right? So there's like unpredictable things happening. Our first insurance policy canceled on us because of heightened fire risk in California now. So I think like be optimistic, be confident that you can do it. But when you're running your analysis, be also skeptical, because then if it works with the skeptical mindset where everything is 20 to 30% worse than you actually think it's going to be, you have an absolute home run of a deal. And then if things just happen how you think they're going to happen, you're already way in the green, let alone if things happen better, right? If our home that appreciated 29% while we were building, I'm not going to go around and say, build in Colorado Springs, 29% is guaranteed, right? Because that was a crazy anomaly. But if you don't try these things, that can't happen. And we modeled out, 0% growth, 3% growth. We were comfortable with all that. So when 29 hit, it was just like, it was wild. But we would have been able to weather the storm either way. It just would have taken us a little longer to start these next projects because that equity is kind of what's fueling um, our ability to do all this construction work now.
So just to kind of give an example, when you say the equity, What are you specifically doing to be able to tap into it?
So we have a home equity line of credit, which I'm a huge advocate for. 20-second cliff notes on home equity line of credits or HELOCs. Basically, you can use them for anything, right? You're not restricted on the usage. It's not a loan where you get all the proceeds on day one and you start to owe payments. It's a line of credits. It's a revolving, it functions like a credit card. So you can not draw from it for 3 years after opening it, and you won't owe any payments because you have incurred no debt. And for a lot of them, you can make interest only payments for the first 10 years, which I don't do. I like to pay down the debt, but you could, right? If you're in a stretch cash flow situation for a couple of years, paying interest only, allows you to obviously make smaller payments. A lot of them have variable rates. I think there are fixed rate offerings too, but ours is variable, so it moves up and down prime, which is nice when you enter into it in a high rate environment, because in theory that's going to come down over time, right? Obviously, it could go up over time too. You never know, but it feels like rates are going to come down. We
Yeah,
will see.
hopefully.
Hopefully. So yeah, so those are HELOCs in a nutshell. And you can usually get, I think, up to around 85% loan to value, which means that if your home is $1 million and you owe 600,000 on your mortgage, right? 85 loan to value would be $850,000 in this example. So if you already have 600 of that on your mortgage, the difference, 850 minus 600 or 250 grand, you could get in a HELOC. And then it's just this blank check to use when you want, on what you want. And it gives you a lot of flexibility and power to go buy that next thing.
And for you guys, what are some of the things that you guys utilize that for on this process? Down payment, closing costs, rehab, mix of all of it.
For us, it's pretty much all construction and rehab.
Cool.
So we waited to save up for the down payment here so we could make that in cash. And then we want to just use our HELOC funds to fund these projects once they get going. So redoing the ADU, doing the addition, we're doing a kitchen remodel, right? Digging out that huge hill. There's a bunch of things. We're not going to be able to afford them all right now. But I want to use all the HELOC funds, and then probably a little financing as well. I'm a pretty big believer in leverage. In general, I think I have a higher risk appetite for leverage than your average person. But yeah,
Why do you think that is? Where does that come from? Confidence in ability to generate income, job or otherwise, or kind of where does that come from?
That's part of it. We have pretty stable, secure jobs here. Like that's part of the reason I went into accounting. Like when a company lays people off, their accountants are the last people to get laid off because they need to issue financial statements and do like taxes to be in business. It's a compliance function. It's like a must. So there's that. My girlfriend has a pretty secure job as well. So I think that's part of it. And then also, I post about leverage on Twitter and I'll show, two examples, right? An example where, Joe has 100,000 and Matt has 100,000, right? Joe goes and buys a house worth $100,000, all cash. Matt buys a house worth $500,000, 20% down payment, right? So Matt's leverage 5-1 in that scenario. If both houses go up 5% that year, 5% of 100 grand is 5 grand, 5% of 500 grand is 25 grand. So your equity return on your cash is already times 500% in the first year. And then you compound that times, 10 years. It just has an insane potential positive upside for you. So I'll lay out a scenario like this, and then everyone on Twitter says, well, what about the downside? Right? What if it depreciates? And to me, that doesn't matter. I know this is a controversial take. I'm sure people will get angry by this, but to me, that doesn't matter because if I don't have to sell and I can make the payments on the house, the valuation of the house, like 1 year after I buy it, has no impact to me. I'm just going to hold it, live in it, or I can rent it. And from a cash flow perspective, I know I'm okay. And then unless I'm being forced to sell, which, again, feel pretty stable about our jobs, I don't think I will be, then I'll hold it. And then it's a market that I believe in. So even if it went down a little bit right after I bought it, it's going to come back up. Real estate, it's thousands of years old as an asset class. It always goes up. So I feel pretty confident that that'll turn back around and it ultimately won't matter. Now, I do acknowledge that we could get fired, we could need to sell. There's like this possible risk that everything goes wrong and I sell for a loss. Okay. And then if I'm leveraged, that loss is a little bit, amplified. So I'm not saying there's no risk, but like I said, my risk appetite there is, I think, a little higher than the average person. And for the reasons I mentioned, I'm willing to take that on.
So when you kind of map things out, initially here, or projecting things out, you have these projects that you're working on the current property in San Diego. Kind of where do you see things going down the road in terms of maybe the next opportunity? How many years out, and what do you envision that maybe looking like?
So I mean, I would say, um, I would say that the next opportunity for us, so this construction is going to take a while to afford, while to complete. And that's mainly what I'm thinking about right now. I do wonder, so we have the addition, the remodel, the landscape, all that stuff can happen in the next year. The detached ADU is going to be pretty expensive, right? Because if it's 300 per square foot, we're talking about 740 square feet, right? That's like close to 250 grand. So that's going to take a while to afford. I'm thinking about maybe buying another property before doing that. It really depends on, how willing we are to keep living here. With all these tenants on the property, I like to think that, we could house hack and, um, it's great financially, but then eventually we're going to have probably kids in the next 5 to 10 years. Do you want people that we're sharing walls with during that? I don't know. So we will see. Part of me definitely wants to just own more of San Diego. The ADU would be a cash flow play. So owning more would be an equity play, right? And that debate is as old as time. So yeah, I would say one of those two routes probably.
Cool. Yeah, I mean, I think that's the biggest thing, right? Like when I'm talking to people about real estate, the biggest limiting factor is, well, I want to do XYZ. Well, how much cash do we have available? How do we plan for XYZ if we have it or don't have it, and how do we make up the shortfall in timing? And that's the hard part. And a question that I haven't asked, and I wish I would have asked it earlier, kind of on that grand scale of saving. I mean, where do you think, strive for 25, right? The 25 is, hey, if you can build your life to be able to save 25% of your income, then you're going to have options on how to invest. As you guys have kind of gone through this journey and now into a different market, and your mortgage payments higher, with rates are higher and all this stuff, how has that changed along the way from a household?
So you're asking kind of the evolution of like our income to saving ratio and how that's been changing.
Mm-hmm.
Um, so I mean, we've been very fortunate with our income and our W-2 jobs. We've each job hopped a little bit and had some raises, had some promotions. Um, so we each make roughly like 3 times what we made coming out of school, in, five, 5 or 6 years. So feel very lucky to, be in that position. Um, and we have a relatively good discipline with spending. Obviously, everyone has their things, right? For us, we love to travel. I think it's a good way to spend money, right? No two people will agree on spending money the exact same way, but I think it opens up your horizons and it's a good experience. We have two dogs. The dogs are always going to the vet. That's expensive. We furnished the whole house in Colorado Springs. It's a pretty big house, right? Over 3,000 square feet. We furnished all that. And then when we were moving, we like had to sell a lot of the furniture because this house is like 700 square feet. So took, a hit on some of that furniture for sure. Um, so there's a few things like that. But I mean, ultimately, we eat at home and we don't, buy all these frivolous clothes, and we're pretty disciplined. I'd say I'm the main driver of that discipline. Because to me, like, since I'm so motivated for financial freedom, spending money on not financial freedom is essentially like selling years of my life, right? If I buy this leather jacket that's $400 and after you deal with taxes and whatever my income, my hourly income is, let's say it's like, I don't know what it is, but let's say it's $60 an hour, right? Then that's 360, that's like 6 2/3 hours um, of my life that I just sold for a jacket, right? So that's like a day of working almost. And I don't ultimately want to be working when I'm older. So then like the jacket doesn't seem that good to me. So I wear plain t-shirts. I wear the same stuff I've worn for years. So I think, we try to be pretty frugal. And to your question about just the overall ratio, so our payment in Colorado Springs was roughly like 10% of our gross income, our mortgage payment. So that was like a nice position to be in. That said, when we got there, it was a new build. So new builds are at a dirt lot. You have to do all the landscaping. There's no blinds or curtains, right? You have to do all that. As I mentioned, we had to furnish it. So we were definitely spending that money. But if you, whittle it down to just recurring expenses, um, we were in a good spot to be able to save. Now, our payment's much higher. We're in less good of a spot, which bugs me a little. It's still less than a third of our gross income, which, depending on where you look on the internet, you'll see a half, a quarter, a third, net gross, all these different things. I haven't found like a unanimous rule, but I think under a third of gross is decent. And once we're able to rent the ADU, the one that's already built, then we'll be in like a pretty good spot. So that was kind of a big part of the strategy with buying this home. Obviously, we thought we could rent it right away back then, but we just knew that we were going to be able to cushion the payment pretty shortly after our purchase with that ADU rental.
That's awesome. Yeah, I mean, I think you talked about the flexibility of someone maybe wanting to go take a year and go to New York or France or Europe or whatever, and then trading time, doing stuff right now. Is it going to help you reach your goal of financial freedom, or is it going to make that time longer? And so for you, you've placed this value on financial freedom, and other people, in general, either whether you're your age or not, other people don't place the same value, or they don't think it's possible, and so they're not even thinking about it. And I think that's just something that, that's the reason why we're here trying to do what we're doing, and the same thing with you on your platforms. Just trying to raise a little bit more awareness, share some examples and stories of what we're doing, and hopefully it inspires somebody else to take that leap. And so, if anybody has any questions or wants to reach out, where can they find you again on Twitter?
Yeah, so they can find me at the cash flow guy. That's the cash flow underscore guy on Twitter. Yeah, I'm putting out content pretty much every day. Sometimes when I'm slammed, I'll miss a day here and there. But no, I'm pretty good about it. It's a lot of fun. So yeah, for anyone who's listening, would love to engage there.
Cool. I know we're running out of time here, but any other big goals for the year, or goals in general? It doesn't have to be a big goal, just a goal.
For the year, let's see, we've got like 5 months here. I'd really love to get these construction projects kicked off and have some meaningful progress made. Um, it's been difficult, finding the right contractor and figuring out how to speak their language. So So I think that's the big one uh, coming up here. I want to hit profitability on my Amazon product. I think I'm close to that. Um, no real quantitative goals for Twitter. Would just like to keep growing, keep meeting people. I'd say that's
Love
pretty
it.
much it for now.
Love it. I mean, yeah, obviously we're going to keep following you in your channel and keep supporting, and can't wait to catch back up down the road and see some more progress on all the stuff you have going on. But yeah, thank you so much, Cashflow Guy, and appreciate your time, and we'll catch up soon.
Really appreciate it, Joel. Thanks for having me.
All right, take care. Bye.
You too. Bye bye.